One of the more interesting developments for SoFi's business in 2024 was the growth of the lending business. Management told investors at the end of 2023 that 2024 was going to be a down year for its lending business. They forecasted the lending business would be down anywhere between 5 to 8%. But as it turned out, the lending business actually grew in 2024. And in the most recent quarter, the lending business absolutely thrived. So that's what this video is going to be about. The growth in SoFi's lending business, the factors that are driving that growth, and some interesting things about its lending business that investors should know about. So let's take a deeper dive.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so SoFi said for the full year ended in 2024, lending segment net revenue of $1.5 billion was up 8% from the previous year, while adjusted net revenue was up 11% from the prior year. And that caught me by surprise as the year progressed, right? Because SoFi was updating investors throughout the year, and they kept telling us that, things are getting better. Things are better than we expected. Things keep getting better. And when they talk about that, they mean the macroeconomic environment was getting better. And so they ramped up lending. The business grew 8% when they were forecasting a decrease of 8%. So that was much better than expected for SoFi stock investors. Now, within its lending segment, SoFi does personal loans, student loans, and home loans. And by far, the largest part of its business is the personal loan business, which is also the riskiest loans you can make. And in the most recent quarter, one of the positive developments was that the student loan business increased by a percentage that was higher than the personal loan business. You can see student loans increased from $7.4 billion in the September quarter up to $8.2 billion in the December quarter, while personal loans grew from $16.2 billion in the September quarter up to $16.6 billion in the December quarter. So the growth rate in student loans much faster than the growth rate in personal loans, which is what I've been hoping SoFi manages to do, to generate growth from these other loan segments. Now, the home loan segment is still a very small part of its business, but it also grew much faster than the personal loans, growing from 80 million to 149 million, almost doubling quarter over quarter. Remember, they made a recent acquisition of a home loan company, and that's helping facilitate some growth in that segment. As investors, you should hope for the home loan segment to continue growing. It's the most lucrative part of the lending segment in terms of risk versus reward. You can get higher interest rates on personal loans as a lender. You can get a better rate of return. But as I'm going to show you, the default rates are also much higher for personal loans. All right, so here I have the weighted average coupon rate and the weighted average default rate for personal loans and student loans. And then you can compare the big difference, right? So for personal loans, SoFi generates a weighted average coupon rate of about 13.5%, right? That's more than double what they can get when they give out a student loan, which was only 5.9%. So you can understand why SoFi's management team is accelerating the growth in the personal loan segment, because the rate of return is so much higher. And also it's easier to find customers to borrow personal loans than it is to find customers for student loans. The student loan market is smaller than the personal loan market. There's a lot more willing participants to borrow money if you give them a personal loan. But look at the weighted average default rate. 4.5% for personal loans, only 0.7% for student loans. So a significant increase in defaults happens with personal loans compared to student loans. And so that's why I've always been talking about this with SoFi, and one of the risks with SoFi investors is this very high default rate. But something else that's been happening that's been very positive for SoFi. Let's talk about that. So in the fourth quarter, they generated a record loan volume of $7.2 billion, and that was up 66% year over year in loan growth. Personal loan originations were up 63%, inclusive of the $1.1 billion they originated on behalf of third parties. Home loan volume was up 87%. Overall, they sold or transferred through their loan platform business more than $3.4 billion of personal loans, home loans, and senior secured loans. And that last part is the big key on why SoFi's loan business was able to grow as much as it was, because SoFi was able to sell $3.5 billion worth of their loans that they originated to third parties. They didn't have to keep them on their books. They could originate and sell, generate fees every time they do that. And that's a more lucrative business model than originating a loan and then keeping it on your books and waiting for people to pay you back. You get a better rate of return if you originate the loan and then sell it to a third party. But the problem with that originate and sell business model is that sometimes the market for selling those loans disappears, like it did in late 2022. That market was almost non-existent. And companies like SoFi and Upstart is another one that really struggled because they weren't able to sell off those loans to third parties. There was no appetite from lenders to lend this type of capital. And so they weren't purchasing these loans from companies like SoFi and Upstart. But in the last 6 months of 2024, the appetite from lenders for these types of loans to purchase these types of loans was insatiable. They were adding billions and billions of dollars of commitments of these types of lending products. So lenders are now very interested in buying up these loans. Lenders are not fearful anymore of a recession, and so they're wanting to put out their capital because they like the rate of return they're getting, 13.5% on a personal loan. They like that rate of return, and so they want to put out capital for that type of product so that they can generate that type of return, because they're not afraid that the people who are borrowing this money are going to default at a high percentage. They're not concerned that the rate of defaults are going to increase, which I think they should be, because default rates have been rising significantly across the board. Whether you look at personal loans, car loans, credit card debt, etc., default rates among consumers are rising and quickly. And so lenders are not taking heed of that trend, and they're more so looking at the macroeconomic picture with the U.S. economy at very low unemployment, with the U.S. economy growing, with the inflation rate declining, the Federal Reserve and Central Bank decreasing interest rates. And so they're focused on those factors more so than the rising default rates that are trending. So that's good news for SoFi, right? The better the appetite from investors for these loans, the better for SoFi, because then it can originate these loans and sell them and generate nice hefty fees, nice returns on invested capital for those brief moments where they hold that loan on their books and then sell it to an outside lender. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.